Looks like someone's been doing their homework. You sent over a ton of stuff on Taparia Tools Ltd, financial statements, company announcements, even a stock analysis from Screener Not In.
Wow, yeah. Someone's serious about getting a handle on their performance.
Exactly. And that's what we're here for, right? To help make sense of it all.
Absolutely. Gotta love that deep dive.
So Taparia Tools, big name in hand tools, been around forever it seems.
Yeah, they make pretty much everything. Wrenches, screwdrivers. I even saw they make those giant truck wheel wrenches.
No kidding.
And they've had this partnership with a Swedish company since, get this, 1969.
Wow, that's a long time. Okay, so let's get down to business. We've got filings from February and May of 2024, and even some more recent updates from September. What are we really hoping to learn here?
I think the big question is,
Yeah.
how are they actually doing?
Yeah, are they profitable? Should we be buying their stock? Are there any red flags?
Let's start with the basics.
Hmm.
One thing that jumps out right away is how financially solid this company seems to be. Screener.in even calls them almost debt-free.
And when you look at their balance sheet, their debt really is tiny compared to their assets.
Exactly. That's always a reassuring sign.
Yeah.
But here's where things get interesting. Their profit growth has been phenomenal. We're talking a 32.6% compound annual growth rate over the past 5 years. That's a CAGR of 32.6%.
That's incredible. Not just good, incredible.
Fully. That kind of consistent upward trend usually means a company's doing something right.
Yeah.
And you can see it in their earnings per share, too. It's been climbing right alongside those profits.
Okay, so they're profitable, but are they sharing the wealth?
Oh, they're sharing. All right. Screener mentions a dividend yield of 457%.
Okay.
I had to double check that number myself.
457%. Can't be right, can it?
It's unusual, for sure. But when you look at their history, it actually makes sense. In 2024 alone, they declared 3 interim dividends. 200% in February, another 200% in May, and then a massive 250% just this past November.
And to top it all off, they had a final dividend of another 200% back in May. You'd think they'd be running out of cash, but they're still maintaining a really strong return on equity, over 30% in recent years. It's like they're defying gravity or something.
Right. It's pretty impressive. One thing that might be contributing is their efficiency. Screener.in points out that their working capital requirements have shrunk considerably, from 78.2 days down to 61.5.
So they're managing their cash flow better? That makes sense.
Yeah, turning over inventory faster, collecting receivables quicker, all of that frees up more cash for either reinvesting or, more dividends.
Okay, so this is all sounding pretty rosy, but I know there has to be a but coming. There always is.
You're right. There are a couple of things that need further investigation. For example, Screener.in flags these contingent liabilities. The figure is pretty significant, too. 56.2 crore rupees.
56.2 crore. That's a lot of money. What does that even mean for someone trying to understand their financial health?
Well, contingent liabilities are basically potential obligations. What if scenarios. Yeah.
Oh, I see.
They could be related to lawsuits, disputed taxes, all sorts of things.
So it's like this shadow, this potential cost that could impact them down the line.
Yeah, exactly. We don't know the specifics yet, so it's worth digging deeper to see if it's something to really worry about.
Okay. And what about that new plant project, the one in Vapi, Gujarat?
Ah, yes, that.
Mm.
In their May 2024 audited financials, it's classified as investment property.
Right, because it doesn't seem like it's going anywhere.
Exactly. And that raises some questions. Why was it seemingly abandoned? Was it a strategic decision? Did they run into problems?
Maybe they hit a wall with costs or regulations. Or something else entirely. Who knows?
It's a bit of a mystery. And frankly, it makes the whole Taparia Tools story even more interesting.
It really does. So far, we've seen amazing financial performance, fantastic dividends, but then we have this potential liability hanging over their heads and this major project that seems to have gone off the rails.
It's a real cliffhanger.
Totally. It's like a financial detective novel unfolding in front of us. But we're just getting started.
Stay tuned, because next up, we're diving into their cash flow statement.
We'll break it down, see where the money's coming from, where it's going, and try to get a better grasp on what Taparia Tools is really up to.
This is where the real detective work begins.
Okay, let's crack open this cash flow statement.
Time to see how Taparia Tools is actually managing their money.
Yeah, like where's the cash coming from and where's it going?
Exactly, like looking under the hood.
Love that analogy.
And for the half year ending in September 2024, Their cash flow from operations is almost 500 crore rupees.
Wow, that's a pretty healthy flow.
Yeah, a strong river of cash.
Okay, so we know the river's flowing strong, but let's break it down.
Sure.
What are the major tributaries feeding this river of cash?
Well, the bulk of it is coming from their core operations.
Meaning the sale of their hand tools?
Exactly. But they also have other streams of income, like interest earned on investments.
Right, so they're not just making money from selling tools.
Yeah.
They're making their money work for them.
Putting that cash to work? Smart.
So where is all this cash going?
Well, they're definitely investing in their future.
Oh, how so?
A good chunk of that cash flow is going towards fixed assets, things like new machinery and equipment.
Makes sense, got to boost that production capacity.
Right, and of course, some of it is going towards those dividends we talked about.
Ah, yes, those generous dividends.
That keep the shareholders happy.
But this is where I get a little curious.
Okay.
Remember that investment property line item?
The Vapi plant project.
Yeah, the one that seems to have stalled.
Right, and looking closely at their investing activities, we see that Taparia Tools has been selling off some of its investments.
Interesting. Why would they do that?
Well, it could be a strategic move to free up cash.
Free up cash for what, though?
Potentially for something big, like an acquisition, perhaps.
Yo, an acquisition?
It's a possibility.
That would be a major move.
It would indeed.
So they're consolidating their resources, maybe getting ready to make a big splash.
It's definitely something to keep an eye on.
It adds another layer of complexity to their story.
For sure, and it highlights how different financial statements can work together to paint a more complete picture.
Okay, like that.
The cash flow statement shows us the dynamic movement of money.
The ebb and flow.
Exactly. Well, the profit and loss statement provides a detailed breakdown of revenues and expenses over a specific period.
Okay, so if the cash flow statement is the river,
Yes.
the P&L is like zooming in on the individual drops of water.
A perfect analogy.
So what jumps out at you when you look at Taparia Tools P&L?
Well, their operating profit is consistently on the rise.
So they're becoming more profitable over time.
Precisely. A great sign.
But is that growth just coming from increased sales?
Not necessarily.
Or are they becoming more efficient at managing their expenses?
It seems to be a bit of both.
Okay, so tell me more.
Their revenue is growing, yes, but their operating margin is also improving.
Operating margin. Remind me what that is again.
It's a key measure of profitability, how much profit they're making on each rupee of sales.
Oh, right.
So they're not just selling more, they're selling smarter.
Becoming more efficient.
Exactly.
That's a good sign of a company that really has a handle on its costs.
Absolutely. And if you dig a little deeper into the P&L, you can see how they're achieving this.
Oh, how so?
They've been strategically managing their inventory and working capital,
Smart.
making sure they have enough to meet demand without tying up too much cash.
It's like a well-oiled machine.
Each part working in harmony.
But even the best machines need a checkup now and then.
True.
And if we remember those contingent liabilities we discussed earlier,
Right.
It's like a little warning light,
Flashing on the dashboard.
telling us to take a closer look.
Even a seemingly small issue, if ignored, can snowball into a bigger problem down the road.
So where do we go from here? Do we need to break out the magnifying glass and analyze these statements line by line?
Maybe not line by line, but there are some specific financial ratios we can look at.
Ratios.
Yep.
Is this where the math gets a bit more intense?
Don't worry, we'll keep it straightforward.
Okay, good.
We'll focus on the ratios that are most relevant to someone like you, who's clearly interested in Taparia Tools' financial well-being.
Okay, you've got my attention.
Yes, sir.
Ratios that speak my language.
Exactly.
Let's hear them. Okay, hit me with those ratios. You know I'm all about those dividends, so let's start there.
All right, since you love those dividends so much, let's look at the dividend payout ratio.
Dividend payout ratio. Okay.
It basically tells us what percentage of the company's profits they're paying out as dividends. And for Taparia Tools, it's been hovering around 60 to 65% in recent years.
So a pretty significant chunk of their earnings, huh? But can they keep this up? Is it sustainable, or should I be worried about a dividend cut in the future?
Well, to answer that, we got to look at the bigger picture.
Okay.
Their profitability, debt levels, all of that plays a role in whether those dividends are sustainable long-term.
Makes sense. So let's start with profitability. What's the story there?
One of the best ways to measure profitability is the return on equity. ROE, for short.
ROE. Okay.
It basically tells us how effectively the company is using its shareholders' investments to generate profit.
Got it. And we know Taparia Tools has a pretty impressive ROE.
Oh, yeah. consistently above 30%.
So they're generating strong returns for their investors. That's a good sign for those dividends. But what about their debt? We know they're practically debt-free, but could even a small amount of debt mess things up?
That's a great question, but it seems they've got that covered too. Their debt-to-equity ratio is really low,
Low debt to equity, okay.
so they're not relying heavily on borrowed money, which gives them more flexibility to keep paying those dividends even if things get a little tough.
So they're profitable, they've got low debt, and they're consistently paying out those juicy dividends. What's not to like?
Well, we also need to think about efficiency. Are they getting better at managing their assets and turning those assets into revenue?
Okay, how do we measure that?
We can look at the asset turnover ratio.
Asset turnover, all right.
It basically shows us how efficiently a company is using its assets to generate sales. And guess what? Taparia Tools' asset turnover has been trending upward.
So they're getting more revenue out of their assets. That's good, right?
Absolutely, they're becoming more efficient. It really does seem like Taparia Tools is checking all the right boxes.
Yeah.
But how do they stack up against their competition?
Yeah, are they leading the pack or are they lagging behind?
Well, that's where Screener.in comes in handy again.
How so?
They have this awesome peer comparison tool that lets you see how Taparia Tools' financials compare to other companies in the same industry.
Perfect. I know what I'm doing after this. But before we wrap up, let's recap what we've learned today.
That's good.
We uncovered a company that seems to be financially healthy. They've got a great track record of profitability, and they love sharing those profits with their shareholders through dividends.
Not to mention they operate with low debt and are incredibly efficient at managing their assets.
But of course, we can't forget those little question marks, those contingent liabilities, and that stalled plant project in Vapi.
True. Those things are definitely worth keeping in mind.
They add a bit of mystery to the story and remind us that even with a company as promising as Taparia Tools, we always need to do our due diligence.